They say history doesn't repeat, but it rhymes. And right now the rhyme is getting louder. Circle this date in your mind, March 11th, 2026. Not because something magical happens that day, but because it's the final stretch before a decision that could reshape the global financial system. 6 days later, on March 17th and 18th, the Federal Reserve's Policy Committee meets, and that meeting may determine whether the US dollar continues its long-managed decline or enters a far more chaotic phase. This isn't just another routine gathering. It could be one of the last defining moments of Jerome Powell's leadership, with his term nearing its end and the political pressure surrounding monetary policy reaching a boiling point. If you've ever wondered how reserve currencies fall, how financial eras end, and how wealth shifts during those turning points, this is the moment to pay attention. Because whether the outcome is calm or turbulent, the consequences ripple across markets, savings, debt, and the future of global finance. Right now, the United States faces a convergence of forces that rarely align at the same time. Massive national debt, rising interest costs, geopolitical tension, and questions about central bank independence are all colliding. The national debt has climbed into territory once considered unimaginable, expanding faster than economic growth and faster than government revenue. Each year, more borrowing is needed just to cover existing obligations, and a growing share of the federal budget is consumed by interest payments alone. When interest becomes one of the largest expenses a government has, the math starts tightening. The system can still function, but flexibility shrinks. Every rate decision suddenly carries more weight, because higher rates mean higher borrowing costs, while lower rates risk reigniting inflation. That tension sits at the heart of modern monetary policy. For decades, the dollar-AS global dominance allowed the United States to operate with advantages no other nation truly had. Countries around the world held dollars for trade, for reserves, for safety. That demand helped keep borrowing costs manageable even as debt expanded. But global finance is never static. Over the past several years, there has been a gradual diversification trend. Some countries are increasing gold reserves, others are experimenting with local currency trade agreements. Still others are simply trying to reduce dependence on any single currency. None of this means the dollar suddenly disappears, but it does mean the system evolves. Reserve currency transitions historically take years or decades, not weeks, yet they often begin quietly, with small structural shifts that only become obvious in hindsight. At the same time, domestic political pressure on monetary policy has intensified. Central bank independence has always been one of the pillars supporting confidence in modern economies. The idea is simple. Elected officials focus on fiscal policy and governance, while the central bank focuses on price stability and financial conditions, insulated from short-term political goals. When markets believe that independence is strong, policy decisions carry credibility. When that independence appears threatened, uncertainty grows. Investors start asking whether future rate decisions will be guided by economic data or political priorities. Even the perception of that shift can influence bond markets, currency valuations, and global capital flows. As the March meeting approaches, the Federal Reserve faces a familiar but difficult balancing act. Economic growth indicators suggest moderation in some areas, while inflation remains a concern in others. If rates are lowered too quickly, inflation expectations could rise again. If rates remain elevated for too long, economic slowdown risks increase. This is the classic dilemma of monetary policy. Act too soon and risk overheating. Act too late and risk contraction. Every central bank faces this trade-off. But when debt levels are high and political scrutiny is intense, the stakes feel higher. Financial markets often try to anticipate these decisions months in advance. Traders analyze employment data, consumer spending, manufacturing output, and inflation reports, searching for clues about the Fed's next move. Bond yields shift as expectations change. Stock markets react not only to what the Fed does, but to what investors believe it will do next. Currency markets are especially sensitive, because interest rate expectations directly influence exchange rates. A signal of easier policy can weaken a currency, while a signal of tighter policy can strengthen it. But in reality, outcomes are rarely that simple. Sometimes markets rally on a rate cut. Other times they fall, worried that the cut signals deeper economic weakness. Beyond the immediate decision, leadership transition adds another layer of uncertainty. Whenever a central bank approaches a change in leadership, markets wonder whether policy direction will shift. Even if the framework stays similar, differences in communication style, priorities, or economic outlook can alter expectations. Investors dislike uncertainty more than almost anything else, and transitions naturally create periods where future policy feels less predictable. That doesn't automatically mean instability. but it does mean heightened sensitivity to every statement, press conference, and economic forecast. Meanwhile, global investors continue to watch US Treasury markets closely. Treasuries remain one of the most liquid and widely held assets in the world, often considered a benchmark for safety. Demand for them depends on many factors: yield levels, inflation expectations, currency stability, and geopolitical relationships. When yields rise, treasuries can become more attractive to investors seeking returns. But if yields rise because of inflation fears or fiscal concerns, that attractiveness can be offset by perceived risk. It's a constant balancing process, shaped by both economic fundamentals and investor psychology. Historical examples remind us that currency systems rarely collapse overnight without warning. Even major transitions tend to unfold through stages. First comes mounting fiscal strain or structural imbalance. Then comes debate about policy responses. Next comes gradual market adjustment, where investors diversify or hedge risk. Only in extreme cases do sudden crises emerge, often triggered by unexpected events or policy missteps. The British pound's decline as the world's primary reserve currency, for instance, unfolded over decades, influenced by wars, debt burdens, and shifting economic power. The transition wasn't a single moment, but a long process marked by several turning points. Today's environment contains echoes of past transitions, but also crucial differences. Global financial markets are far more interconnected and technologically advanced. Capital moves instantly across borders. Information spreads within seconds. Central banks coordinate more closely than in previous eras, and financial tools for managing liquidity and crises are more developed. These factors can both stabilize and accelerate events. They provide mechanisms to contain shocks, yet they also allow market reactions to propagate faster than ever before. For individuals watching from the outside, the biggest question often becomes practical rather than theoretical. What does any of this mean for savings, investments, and financial security? The answer is rarely found in dramatic predictions or single dates. Instead, it lies in understanding risk management and diversification. Economies go through cycles. Currencies fluctuate. Markets rise and fall. Historically, the most resilient financial strategies have been those built on balance rather than extremes. Holding a mix of assets, maintaining reasonable debt levels, and staying informed about economic trends tends to matter more than trying to predict a precise turning point. Gold, for example, has long been seen as a hedge during periods of uncertainty or inflation. Some investors value it for its historical role as a store of value, while others see it as a diversification tool rather than a primary investment. Real assets such as property, infrastructure, or commodities also attract attention during times when inflation risks are discussed, because their value often relates to tangible economic activity. Equities, meanwhile, represent ownership in companies that can adapt, innovate, and grow even as monetary conditions change. Each asset class carries its own risks and benefits, and the right balance depends on personal circumstances and long-term goals. Debt strategy also plays a role in financial resilience. Fixed-rate borrowing can feel very different from variable-rate borrowing when interest environments shift. Similarly, holding long-term fixed-income investments can be beneficial in some scenarios and challenging in others, particularly if inflation outpaces returns. Understanding these dynamics doesn't require predicting dramatic currency resets. It simply requires recognizing how interest rates, inflation, and policy decisions influence financial outcomes over time. The emotional side of market cycles is often overlooked, but just as important. When headlines become intense and predictions grow extreme, people tend to react emotionally. Fear can lead to rushed decisions, selling assets at low points or chasing trends at high points. History repeatedly shows that disciplined, informed choices tend to outperform reactive ones. Markets reward patience more often than panic. Understanding the broader context behind economic news helps transform anxiety into awareness, which is far more useful for long-term planning. As the March meeting approaches, analysts will continue debating possible scenarios. Some will expect rate cuts. Others will anticipate a pause. Still others will focus on the language used in official statements, searching for subtle signals about future policy. The truth is that no single meeting alone determines the fate of a currency or an economy. What matters more is the cumulative path of decisions, economic data, and global responses over time. Yet certain meetings can feel symbolic, especially when they occur near leadership transitions or during periods of heightened fiscal debate. They become moments when attention concentrates and narratives form. Regardless of the outcome, the broader story of global finance will continue evolving. The dollar remains deeply embedded in international trade, financial contracts, and reserve holdings. Shifts in that role, if they occur, are likely to be gradual and complex, shaped by economic performance, geopolitical developments, and technological change. Digital payment systems, central bank digital currencies, and evolving trade networks may all influence how the future monetary landscape looks. But those transformations will unfold across years, not overnight. For viewers trying to interpret the significance of the coming weeks, the most valuable approach is perspective. Instead of focusing on a single dramatic prediction, look at the structural forces at play: debt sustainability, inflation trends, productivity growth, demographic shifts, and global economic cooperation. These long-term drivers shape outcomes far more reliably than any single announcement. By understanding them, you gain insight not only into what might happen next month, but into how the financial world may evolve over the next decade. And that's where the real lesson of history comes in. Every financial era feels permanent while you're living in it. Every dominant currency feels unshakable. Yet over centuries, the global system has always changed, moving from one center of economic gravity to another. The process isn't usually a dramatic overnight collapse, but a gradual rebalancing punctuated by moments of tension and decision. Observing those moments carefully helps us understand the direction of change, even if we can't predict the exact timeline. So, as March 11th approaches and the Federal Reserve prepares for its March 17th and 18th meeting, think of it less as a final countdown and more as a checkpoint in a longer journey. A moment where policy, politics, and global finance intersect. A moment that may influence expectations, market sentiment, and economic narratives, but not the sole determinant of the dollar's destiny. Financial systems are vast, adaptive, and influenced by countless interconnected forces. If there's one takeaway, it's this: preparation doesn't mean panic. Awareness doesn't mean alarm. The goal isn't to predict a dramatic collapse, but to understand the dynamics shaping the world economy and make thoughtful, balanced decisions in response. History rewards those who stay informed, diversified, and patient far more often than those who react to fear. And if you want to keep tracking these turning points, understanding the deeper historical patterns behind modern events, and seeing how past empires, currencies, and economic systems shaped the world we live in today, then you're in the right place. This is Sleepless Historian Explained, where we connect the past to the present and break down the forces shaping tomorrow. If this perspective helped you see the bigger picture, make sure to subscribe, stay curious, and keep watching history unfold in real time, because the future always belongs to those who understand the story behind the headlines.